Hey everybody, Joshua Phillips here with Churchill Mortgage coming to you with the second market update of the week. I mean, it's a pretty big week with the election and with the Fed cut and all of that. I thought it's worthy of a second market update. And here's the thing. The market's kind of surprised me in the last couple of days. As we left things off, if you paid attention to my update on Wednesday after the election, we were saying that, security prices were getting worse, mortgage rates were going up as a reaction to Trump being elected as president, because overall the market thinks that the economy is going to do well, be strong under Trump. And so maybe there's not as much reason for mortgage rates or other rates to improve. So, but, that has been not our experience, as we've seen things actually improve a little bit the last couple of days. So what you were looking at here on the screen is what we always look at, which is a mortgage-backed securities chart. And these are Japanese candlesticks. Feel free to look it up on ChatGPT or Google. But I love Japanese candlesticks because they're very informative, actually. So really all you need to know to understand this when it comes to mortgage-backed securities is red is bad, green is good, and the higher the security price is, the better mortgage rates are doing. So when we left off on Wednesday, we had this red candlestick. We had come down and we had touched this, what we call a floor support. And then yesterday, we got a nice green candlestick. We actually saw mortgage-backed securities improve nicely. I can't necessarily say it was because of the Fed cut, because I don't think that's necessarily the case. But for whatever reason, security prices, mortgage-backed security prices improved a little bit. And then today we've had a little bit of a, kind of a neutral day. We went up and we touched on the 25-day moving average. That's the average of the last 25 days. These moving averages are powerful in the market. And we touched on the 25-day moving average and we kind of went back down. So where we are today, I mean, we 2 weeks ago I made a video and said, hey, have we reached the high for interest rates? Maybe I called it. I hope so. Where we were touching on this bottom line several times, and we've kind of started to improve. Now we've got a lot of resistance ahead. We've got the 25-day moving average, the 50-day moving average, the 100-day moving average. We got a ways to go, but it's been pleasant to see the market actually bounce back a little bit with the election news. Now let's pull out here just to a 6-month chart. That was a 3-month chart, just so you can get a little more perspective on things. We can see that we saw mortgage-backed security prices, as we've talked about, improve just almost every day for like 90 days. We had this, it was wonderful. Wonderful to see rates just improve day after day for about 90 days. Probably rates improved a full percentage point during that time from, May, June, all the way up to mid-September. We saw mortgage rates improve like a full percentage point, which is awesome. But then we fell back down. We lost like 3/4 of a percentage point in interest rate. And now maybe we're starting to go back up. So what we obviously would love to see is a trend back in a positive direction. We're still probably, weeks away from maybe getting back to where we were in mid-September. But, I at least like what we're seeing here. We got some resistance to deal with. The other thing I'll just mention briefly is that I kind of pointed out that if you as a consumer, if you want to pay attention, mortgage rates do reflect closely what's happening with the U.S. 10-year Treasury bond and the yield on that. And so it kind of looks almost the same. You look at a 90-day Treasury where we saw the yield get down to about 3.6%. And then it went up all the way, and we had this little spike here all the way up to about 4.4% on Wednesday. And you can see we've kind of come back down a little bit. So it's been good, but we've got a long ways to go to get back to where we were mid-September. And I was telling you that if you're looking to refinance, because I have a lot of my clients who I send this market update to, if you're looking to refinance, and you want to kind of get to, kind of be patient, wait for an ideal situation, you really want to wait to maybe the 10-year Treasury yields around 3.5, 3.6, at least to back to where we were. So we're probably several weeks away from that happening. These things did not move. As you can see, they move pretty slowly. So it took 2-3 months. It took a couple months to get here. It may take a couple months to get back to where we were. So anyway, but overall, pleasantly surprised to see that little bounce back. That's good news. Maybe if you're looking to purchase a home, maybe we've seen the highs that, for the last several months, and maybe we're seeing things improve just a little bit. And as always, if I can talk to you about your specific situation, interest rates, getting pre-approved, what you're qualified for, I'm totally happy to do that. Here to help any way I can. Let's have our fingers crossed. I hope that maybe next week we see a little more improvement, maybe break through that 25 and 50-day moving average. All right. Take care. Have a great weekend. Bye.